Tesla is down by 27% after reaching a 52-week high of $488 in December. So most Tesla investors are wondering, especially the ones that bought it near the 52-week high, is this a stock that they should sell or something they should double down on if it has great long-term potential? Luckily, that's what we do on this channel. So we are going to analyze the stock and see what its price could be based off its revenue and profitability by 2030. But before I get started, please hit that like, follow, and subscribe button. These are Tesla's current metrics. For us to get a price target, we need to analyze and hypothesize what these metrics could be by year 2030. And that will give us a future stock price for Tesla. Now, if you take a look at Tesla's revenue, it was making almost $25 billion 5 years ago to today making $97 billion. This is an impressive 4x growth in revenue. However, you start seeing a major problem when you start looking at its most recent revenue numbers. So ever since it hit $94 billion in June of 2023, its revenue only has went up by $3 billion over the last 18 months, meaning today it's making $97 billion, which means it has already identified low-hanging fruits and has taken full advantage of them. So even if you go down here at the growth rate, after June of 2023, growth rate has been in the single digits, 8%, 3%. It even had a decline in March of 2024 of 8%, and then the rest are even worse off. Now with this, I can hypothesize that it should have a realistic slow growth in revenue unless a humongous catalyst comes to re-accelerate that growth. And right now, as you can all tell, there's a lot of hype around Robotaxi and Optimus robots. So, I mean, there is a catalyst. That catalyst really doesn't exist yet. Next, we're going to ask ChatGPT what its revenue could be by 2030 based off short-term analyst projections and its long-term growth rate. So, of all the analysts that ChatGPT analyzed, they're projecting $154 billion by year 2027. But ChatGPT estimated its revenue could be $205 billion by 2030. Now, here's the thing. If we have a massive adoption in electric cars, that's very possible. And I'm being honest here, that's very possible. We do have to look at the profit that these cars actually ranking in, but I can see that. But that's a big if we have a massive adoption in EVs. As of late, the opposite trend is becoming popular. People are going more gasoline-driven cars because they are convenient. And with Trump administration, I see that sentiment even picking up more. Well, let's go ahead and ask Gemini and see what it thinks its revenue could be. Gemini said its revenue could be $255 billion based off analyst projections. It thinks it can surpass 310 to 360. Way too high. Way too high. I don't think that's even close to being possible. We're going to ask DeepSeek next. DeepSeek is way out there with almost 400 billion. Holy smokes, that's not happening. I'm sorry, folks. That is just not happening with this current products and services. It has to develop Robotaxi and Optimus robots for it to hit that $400 billion mark. Now, when we ask DeepSeek, it thinks $254 billion. I'll be honest, I think that is the most reasonable estimate that I've seen so far. So I'm going to go with this, which would be an increase in revenue of almost $150 billion over the next 5 years. Its current margin of profit is 7.2%. That is very low. This is because they're reinvesting a lot of their capital to the infrastructure, and this is directly causing their manufacturing and the price at which they're building the cars a lot cheaper. If you go down here, on average, before they started doing this heavy capex spending, it used to be 11, 15, 14, and then around 2024, you can really see that it started declining its percentages to one, stay competitive, second, to bring down the cost that is associated with building each unit. So as far as I know, their cost to develop electrical vehicle is the cheapest in the industry, and this is due to a massive spend that they've been doing on the manufacturing side. Hence why you're seeing a 7.2% profit margin. Now, I believe that is going to be way higher. How high? Let's take a look at its competitors and get a ballpark idea. Number one, BMW has a 5.4% margin of profit. It is a very profitable company, but BMW has a lot of sectors that really don't work that well. One of them being Volkswagen and all the other stuff. Their premium brand, the BMW brand, is very profitable. So this in reality is like a 15% margin of profit, but their subdivisions are causing the overall profit to be lower. Mercedes is a company that solely emphasizes on the higher end market, and you can see they have a 18% margin of profit. And Ferrari has a margin of profit of almost 23%. Now, in my personal opinion, I think is going to have a margin of profit of about 18%, but I know you Tesla investors are gonna kill me and try to compare this to Ferrari. It's not possible, but to save myself from getting on your bad side, I will give it a 23 margin of profit. I hope that makes you happy. Next, we're going to take a look at number outstanding shares. Now, Tesla has never done a single stock buyback ever. At the start of 2019, it had a massive dilution of the shareholder. I mean, it went from 2.6 billion to all the way to 3.4 billion in a matter of only 6 quarters. Now, if we were to measure the dilution it did over the last 5 years, that is 23%. It diluted you as a shareholder by 23%. Here's the thing. Its management has become smarter and wiser. After this massive dilution, it's been only diluting the shareholder by 2% on average per a year. I expect that trend to continue, and I'm going to say that you guys are going to have another dilution of 10% over the next 5 years. Now, it could be more or it could be less based off of how the autonomous and Optimus projects play out. Now, going to PE, it cannot maintain 183 PE. That's just not possible. Eventually, investors are going to start selling if they don't start having massive increases in revenue. And you're witnessing that live right now today. Before, in December, it had a PE of above 200. To today, after the consolidation, having it about 183, and that trend is going to continue. We just have to hope the revenue catches up so the fall doesn't hurt as much. So I'm gonna say a 40 PE for Tesla. It's very possible, and plus this is 5 to 6 times more than what the auto industry average is, which is 10, and we're saying Tesla is going to have a 40 in the future. Now, after plugging all these numbers in, we get a stock price for Tesla for 2030 at above $580. If you were to invest that same money into the S&P 500, you would get above $540, which means you're only doing 11% better than the S&P 500. In my opinion, that is pretty bad. Who wants to take on such a massive risk to only do 11% better than the S&P 500, which basically has a risk-free return? It's not actually risk-free, but it comes damn close, versus Tesla that has a high risk. Now, if we wanted to double our money investing in Tesla over the next 5 years, we need to buy this stock at $291. I'll be honest, the way the pullback is going, this actually could be possible. I would give you a strong recommendation on a buy if it hits below $300. So I'm going to give you my honest opinion. I do not like investing in companies that product and services don't exist yet and their valuation is derived from those services. I don't like investing in companies like these, because what if they never come out with autonomous? Or what if another company beats them to autonomous and takes the entire market share? And we're not even talking about Uber's dominance in this space. So I really don't invest in companies like this. But I'm going to tell you guys something. If autonomous actually plays out, this stock could be worth over $3,000 to $4,000, which would mean you would get 5 to 6x return. But that is only a 20% chance. If you're okay with taking that 20% chance, then you should consider buying Tesla. But if you're a smart investor, I think this stock is a skip. There's way too much uncertainty around this stock for me to even consider buying this stock. And as always, let this analysis be a guide to your investment decision, not something that you should just follow blindly. And with that being said, please like, follow, subscribe, and I'll catch you guys in the next one. Peace.